Are you new to Forex trading and wondering which Forex pairs are best for beginners? In this video, I will break down the most popular and beginner-friendly Forex pairs to trade, offering lower spreads, higher liquidity, and less volatility. Learn how to start trading smartly with these top currency pairs that will help you build confidence as you grow your skills in the Forex market. Whether you're just starting out or looking to refine your trading strategy, this video will guide you on your journey to becoming a successful Forex trader. Don't forget to subscribe for more Forex tips, tutorials, and trading strategies. 1. Pound sterling to US dollar. The Great Britain pound versus the US dollar is one big major Forex pair that institutional traders, big banks, hedge funds trade because of the strength of both the economies. Factors that influence pound sterling to US dollar. 1. Economic data reports. Like NFP, non-farm payroll, unemployment data from the US economy. CPI, Consumer Price Index, inflation data from the USA, GDP, gross domestic production, from both economies. 2. Central bank policies. The Bank of England, BO, and the US Federal Reserve, Fed, influence pound sterling to US dollar through interest rate decisions and monetary policy actions. Any changes to interest rates or economic outlooks from these central banks can lead to large price movements. 4. Geopolitical tensions. Global events, such as trade conflicts or military tensions, can also affect market sentiment and the value of pound sterling to US dollar. Why trade pound sterling to US dollar? High liquidity. Pound sterling to US dollar is one of the most traded currency pairs in the Forex market, thus providing high liquidity. This means that you can enter and exit trades more easily, with tighter spreads, especially during market hours when both London and New York markets are active. Volatility. Pound sterling to US dollar can be volatile, often experiencing significant price movements during key economic announcements, particularly from the UK and the US. This volatility can offer profit opportunities, but it also comes with increased risk. Impact from economic data. The value of pound sterling to US dollar is heavily influenced by economic indicators from both the UK and the US, such as GDP, employment data, inflation rates, and central bank interest rate decisions. The Bank of England, BO, and the US Federal Reserve, Fed, policy like the interest rate decisions play a significant role in the movement of this currency. Market structure and chart patterns. Pound sterling to US dollar tends to show distinct technical patterns that traders can capitalize on. Many traders use tools like chart patterns, Fibonacci retracements, and support and resistance levels to forecast price movements and plan trades. Big major news impact. Political events such as elections, policy announcements, and geopolitical tensions can have a strong effect on pound sterling to US dollar. The UK's relationship with the EU and global events may also add unpredictability to the pair's price action. Favorable trading hours. Pound sterling to US dollar is most active during the overlap of the London and New York trading sessions, typically where in my motherland region, East Africa, it happens between 3 p.m. to 11 p.m. This period offers the highest volume and tighter spreads. Low tight spread and costs. The spreads on pound sterling to US dollar is usually narrow across all brokers because of its high liquidity, which reduces the cost of trading. However, during major news events, the spread can widen, so traders need to be cautious about potential slippage. Good risk-reward ratio. Due to its volatility, pound sterling to US dollar can provide high potential rewards, but it also comes with greater risk. Beginners should use proper risk management strategies such as stop-loss orders to mitigate potential losses. In summary, pound sterling to US dollar offers exciting trading opportunities due to its liquidity and volatility, but traders must stay informed about economic events and manage risk effectively to succeed in trading this Forex pair. 2. Pound sterling to Japanese yen. The British pound versus the Japanese yen is another Forex pair that is so easy and user-friendly to day trade as a beginner trade. Pound sterling to Japanese yen is a popular currency pair in the Forex market that offers both significant trading opportunities and risks due to its volatility and liquidity. Due to its volatility, pound sterling to Japanese yen can be ideal for scalpers who aim for small profits from quick price movements. The high volatility can create frequent trading opportunities but requires quick decision-making. Factors that influence pound sterling to Japanese yen. 1. Economic data. Economic reports from both the UK and Japan significantly impact pound sterling to Japanese yen. Key reports include UK GDP, inflation, CPI, employment data, and consumer confidence, then Japan trade balance, GDP growth, inflation data, and Bank of Japan policy decisions. 2. Central bank policies. The Bank of England and the Bank of Japan play a significant role. The Bank of England interest rate decisions can strengthen or weaken the British pound, while the Bank of Japan negative interest rates and quantitative easing often leads to a weaker yen. 3. Geopolitical events. Political stability, such as Brexit-related news or changes in Japanese government policy, can cause volatility in pound sterling to Japanese yen. Natural disasters, economic reforms, or trade policy changes in either country may also have an impact. Why trade pound sterling to Japanese yen? Good liquidity. As one of the more traded cross-currency pairs, a pound sterling to Japanese yen typically has good liquidity, especially during the London and New York trading sessions. High liquidity often leads to lower spreads, which benefits traders by reducing costs. High volatility. Pound sterling to Japanese yen is often referred to as a volatile pair due to its large price swings, especially during market-moving events. This volatility offers profit opportunities, but it also comes with heightened risk. Support and resistance levels. Pound sterling to Japanese yen tends to respect well-established support and resistance levels. Key Fibonacci retracement levels can be used to identify potential reversal points. Good risk-to-reward ratio. GBP/JPY's volatility can lead to large price movements, which can either generate significant profits or cause large losses. It is essential to use proper risk management techniques such as stop-loss orders. Good candlestick patterns formation. Japanese candlestick patterns, such as doji, engulfing, or hammer, are particularly relevant for traders looking to identify reversal or continuation patterns in pound sterling to Japanese yen. In conclusion, pound sterling to Japanese yen is an exciting and dynamic forex pair that offers plenty of trading opportunities due to its volatility and liquidity. Successful trading in pound sterling to Japanese yen requires a strong understanding of both technical and fundamental analysis, as well as effective risk management strategies. Before we move on to the last forex pair, don't forget to subscribe to my channel for more trading tutorials, hacks, and tips. Alright, let's go on. 3. Euro to US dollar. Euro to US dollar is the most traded forex pair in the world, making it an essential pair for both beginner and experienced traders in the forex market. This pair involves the euro currency of the Eurozone and the US dollar, the global reserve currency. Factors that influence euro to US dollar. 1. Economic data. The value of euro to US dollar is significantly influenced by economic reports from both the Eurozone and the United States. Key reports include US non-farm payrolls, NFP, GDP, inflation data, CPI, and consumer confidence reports. Eurozone, gross domestic production, GDP, inflation data, CPI, retail sales, and economic sentiment indicators. 2. Central bank policies. The European Central Bank, ECB, and the Federal Reserve, Fed, play a critical role in determining the value of euro to US dollar. The European Union decisions on interest rates, quantitative easing, and monetary policy can significantly affect the euro, while the Fed's actions, particularly around interest rates and monetary tightening or easing, can impact the USD. 3. Geopolitical events. Political instability or uncertainty, such as elections, trade wars, or significant international events, can lead to volatility in euro to US dollar. Why trade euro to US dollar? High liquidity. Euro to US dollar has the highest trading volume of any currency pair, which leads to tight spreads and easy entry and exit points for traders. Best trading time. The euro to US dollar pair is most active during the London 11 a.m. to 6 p.m. East African Time and New York 3 p.m. to 11 p.m. East African Time. When these markets overlap, this period is when the most liquidity and volatility are present. Support and resistance. Euro to US dollar respects key support and resistance levels, which can be identified through technical indicators. Trend lines. Or previous price highs and lows. High liquidity. Euro to US dollar has the highest trading volume of any currency pair, which leads to tight spreads and easy entry and exit points for traders. Low spreads. Due to its high liquidity, the spread, the difference between the buy and sell price, is generally low, making it an attractive pair for both day traders and long-term investors. Suitable for scalping and day trading. Given the liquidity and tighter spreads, scalping Euro to US dollar for quick, small profits is a popular strategy, particularly during the active trading hours of the London and New York sessions. Good favorable risk to reward. Due to its liquidity, Euro to US dollar offers a good environment for setting tight stop losses, but it's important to be mindful of the volatility spikes that can occur during news events. Euro to US dollar is an ideal pair for many traders, thanks to its high liquidity, relatively low spreads, and consistent market activity. It offers excellent trading opportunities both for short-term traders, scalpers, and day traders, and longer-term investors. Success in trading Euro to US dollar requires staying informed about economic events, following central bank